Thank you all for coming today. My name is Irene Monasterolo. I'm Assistant Professor of Climate Economics and Finance at the Vienna University of Economic and Business, and I'm here spending a few months of visiting. Yeah, okay.
Sorry, I handed that to you, but I probably shouldn't have. You have it.
So it should work also.
Yeah.
And today it's my great pleasure to be here to introduce you in a stream of research that I've been developing together with an international research team led by Stefano Battiston, a professor at the University of Zurich, who is the co-author of the research I'm presenting today, which is a climate risk assessment of sovereign bonds portfolio. This is just the last of a series of methodological implementations on climate financial risk and impact metrics that we have been carrying out in the last 3 years. Before we start with the presentation, let me tell you a short story of how this all began. We have to step back in May 2015 and go on in Nice on the French Riviera. It was just shortly before I moved to Boston University. I was attending a conference on complexity and evolutionary economics, and I had the pleasure to hear the keynote speech about the price of complexity in financial networks. In that presentation, the keynote speaker showed how financial networks could help us understand interconnectedness and eventually understand potential mispricing in complex financial products. I thought, okay, great. Imagine what happens if we introduce climate in this. I went along and then could at the end talk with the keynote was Stefano Battiston. And nicely, I found out that he was also concerned about the assessment of climate risk in financial networks. And he led at that time on two international research projects. And indeed, this is the results of how the climate stress test of the financial system was born, and a collaboration with an international research team, which includes also Paris School of Economics, Global Climate Fund, and also the Vienna University of Economics and Business. Let's start. We have three men here. What do they have in common apart from being men and working at central banks? The first one is Mark Carney, Governor of the Bank of England. The second one is Véronique de Gallo, Governor of Banque de France. And the third one is Ma Jun at People's Banks of China. They are all concerned about the impact of climate risk on financial stability. They joined a recently created central banks and financial regulators network for greening the financial system with the aim to warn the financial sector against climate physical and transition risk and to identify metrics and methods to help them assessing such risk in their portfolio. In particular, in the first report of the network, which came out a few days ago, they urged about the introduction of a climate change stress test. We will see today what they are and how we can use it. But why is climate a risk for financial stability? Recent events and also recent research, such as the one I've been conducting, shows that climate risk is material for the financial sector, and it could spread via two main channels. The first is physical risk, where more extreme and frequent weather events leads to capital losses and thus to physical stranded assets. The second one is transition risk, which could be led by a disordered introduction of climate policies, which could affect actually profitability of companies in green and brown energy sectors, and thus lead to asset price volatility with potential implications on financial stability. However, we also found that capital is still highly allocated into economic activities that are exposed to such risk. By how much? Well, we showed it in the first climate stress test of the financial system, finding out that in the EU and the US system, pension funds in particular and investment funds are exposed for circa 45% of their equity portfolios to climate transition risk. In addition, such risk could be amplified by the interconnected structure of financial contracts in the financial sector. This shows that climate risk actually could change individual investors' financial risk position and that the losses or gains, if investors have adapted early and aligned their portfolios to the low carbon transition, the losses and gains on assets deriving from climate shocks could be significant and cannot be ignored, in particular by financial supervisors and central banks whose mandate is preserving financial stability. Therefore, there is growing concern and awareness among policymakers, but also practitioners and scholars about the need to address capital misallocation. This requires climate financial risk and impact metrics. It was also recently highlighted by Mafalda Duarte, climate investment funds. But what do we need in this regard? We need to enhance financial risk assessment and standard financial risk metrics to encompass new sources of risk which have not been contemplated so far, such as climate change. But also, we need to consider the characteristics of climate risk and financial risk while we do so. When we talk about climate, we have to consider the non-linearity of climate impacts and uncertainty, the potential achievement of tipping points after which the characteristics of the system could change dramatically and potentially in an irreversible way. We have to understand the time mismatch between long-term climate impacts and short-term financial investment decision, and the potential endogeneity of risk between climate policy and investors' reactions, what we call climate sentiments. We will come back later on this. And the characteristics of finance, because in today interconnected real and financial sectors, risk could propagate from economic activity in which capital is allocated to investors and can be amplified across complex chains of financial instruments. We could see it just 10 years ago during the last financial crisis. How can we develop climate financial risk and impact metrics that take into account these characteristics? We do so by combining financial network models with climate-enhanced financial evaluation of assets based on forward-looking policy shock scenarios. These shocks come from a potentially unanticipated and disorderly low-carbon transition policy introduction. Why we need network models in doing this? Well, on the right, you see a representation of the interconnectedness of the euro area macro financial network that we developed together with Veronica Stolbova and Stefano Battiston in an article we published last year on ecological economics. You see, interconnectedness and complexity is high. How does climate enter in this picture? Well, in two ways. On the one hand, we have what we see here. Concentration of emissions trajectories which affect temperature trajectories. More extreme and frequent weather events could affect firms' capital losses and destruction. On the other hand, we have potential shocks on green or brown energy sectors market share, which come from an anticipated policy introduction. And also, in this case, they affect the value, the firm's profitability, and the value of the financial contracts associated. To analyze to what extent climate change could be a risk for financial stability, we develop an approach to climate financial risk assessment under uncertainty, which is composed of three main steps. The first stands on understanding risk, and understanding that this time, risk for financial actors is different. Because of the characteristics of climate change we discussed before, and in particular what we called before endogeneity pertains the fact that policymakers' decisions about the introduction of climate policies could actually be influenced and their implementation be affected by investors' reactions and potential anticipation of them, which is what we call climate sentiments. Second, we should consider the sources of risk amplification in financial networks, as we saw before. The second step is assessing risk and opportunities for investors, either to stay brown or to go green, under incomplete information. At this regard, we need to assess investors' exposure to climate risk, considering both their first and second round losses, and this is where network models help. And second, we need to price climate risk in the present value of financial contracts by introducing climate into standard financial risk metrics that investors use, like the value at risk or the spread for the bonds. Third step is about mitigating risk. So, showing scenarios of portfolios rebalancing that could allow financial investors to avoid massive losses and even to achieve gains in the low carbon transition. This, of course, could imply also a role for macroprudential measures of central banks. This is the structure of the paper that I'm presenting today, which is a climate risk assessment of sovereign bonds portfolio and which is available on SSRN. We have 3 research questions for today. The first one is, can we measure individual portfolios' exposure to climate transition risk? Can we price risk and opportunities of potential alignment or misalignment with the climate targets in the value of individual financial contracts? And with this I mean, what's the cost in terms, for instance, of sovereign bond spread for an investor to stay on a misaligned trajectory with the climate target? So to be highly exposed to fossil fuel or carbon-intensive companies and assets. Then, if I were an investor, should I keep my exposures to governments who have not embraced yet the low-carbon transition, such as Poland, and to their sovereign bonds? The third step is understanding what implications could we derive for central banks' micro and macroprudential regulation in order to inform financial stability measures. We have 4 take-home messages. The first is that we develop an approach to climate financial risk management under uncertainty based on financial network and financial pricing models where we introduce climate. We price forward-looking climate transition risk in the value of sovereign bonds in this application, where the channels of risk transmission work from a disordered climate policy introduction to asset revaluation, which could be both positive or negative, and eventually in the change of portfolio value. We then include climate into standard financial risk metrics. Since in this presentation we focus on sovereign bond, we have developed the climate matrix spread, which shows that investments misalignment to a 2 degrees aligned scenario could worsen the financial and fiscal position of a country and of an investor via a changing in the sovereign bond yield. Finally, what we see from our results is that climate risk can already change the financial risk position of an investor, and thus these results should be taken into consideration by financial supervisors. This is the last, as I said before, this is the last step of a stream of research that we have developed and applications. The first one was an application of the climate stress test methodology to equity holdings that we published in 2017 on nature climate change, and an analysis of investors' vulnerability and relevance that we published on climatic change. Then we did an application on energy infrastructure loans of Chinese development banks. And finally, this paper is on sovereign bonds, plus there is a paper just published on SSRN on corporate bonds. This is the first example of the climate stress test published on Nature Climate Change, where we actually estimated the climate value at risk for the equity holdings of the 20 most affected banks under scenarios of green or brown investment strategies. As you can see, this is the value of the losses on the x-axis, could be significant. A climate risk assessment of sovereign bonds portfolio. The first step we embrace is understanding risk. We know that from recent analysis, climate data evidence is not normally distributed. based on the last work by Frank Ackerman, which shows that the Western European summer in 2003 was 4.5 standard deviations above mean temperature for the last 150 years. With normal distribution, 5.4 standard deviation summer would have occurred once every 30 million years. However, we had a similar heat wave in Europe in 2010. So if such events happen every 7 years, they must be not normally distributed. In this regard, we can discuss about two types of risk. The first type of risk is if we know what we don't know. Here you see a standard financial risk metric used by investors, which is the value at risk, which is also used by central bankers to set capital requirements for banks. With a value at risk, the value at risk is the value that investors should keep aside to avoid massive losses in 95% of cases, and this stands on normal distribution of shocks. So when we compute the value at risk, we're supposed to know the distribution of the shocks. However, in presence of fat days, we can't assume the normality of the distribution of shocks. This means that we cannot run a traditional value at risk. However, most of traditional models still assume a linear shock transmission from climate to prices. We have also a second type of risk, which is if we don't know what we don't know. There are several situations, such as climate, in which we don't know the distribution of shocks, and thus we need to work with scenarios. This is not new at all. The figure that you see on the bottom right comes from Royal Dutch Shell and dates back at least a couple of decades. Scenario analysis can help when we don't know the probability distribution, because we can decide what, for instance, in the context of climate change, what climate scenario could be feasible and relevant for the business of the financial actor involved. We can compute losses conditioned to each scenario, and eventually we could identify portfolios rebalancing strategies that could help us to mitigate such risk and adapt. The second step is identify the relevant and feasible climate policy shock scenarios. There are two main shocks. When we talk about climate transition risk, we talk about two main types of shocks. The first is unanticipated technological shocks. For instance, the fast decrease in renewable energy production cost, which occurred in the last decade, could destroy value in the fossil fuel industry or eventually create value in the renewable energy sector. However, most investors did not discount currently the future value of investments in the assets having either fossil fuels or renewable energy technology as underlined so far. The second type of shocks within transition risk are unanticipated climate policy shocks. And here we have two clear examples where investors did not discount correctly the future value of the investments. The first one is that the signing of the Paris Agreement. It comes at surprise for many. And the second is the announcement of the US administration to withdraw from the Paris Agreement in 2017. The third step is developing metrics to assess climate-related financial risks and opportunities. How we do so? By combining network-based climate stress tests with a theory of financial decision-making under uncertainty. We propose a modular approach that uses micro-level firms and asset data. First, we compute the portfolio's exposure to individual contracts. In this case, we are talking about sovereign bonds. Then we estimate the changes in the market share of high and low carbon sectors and firms under a climate-aligned scenario. In this case, we consider a 2 degrees C aligned scenario by 2030. Then we price climate shock transmission in the change in the value of the individual financial assets through the application of a new financial pricing model. And last, we assess the largest losses or gains in portfolio's value, in particular by introducing climate into standard financial risk matrix. One is the climate value at risk, and the second is the climate spread to factor climate in bonds yield. This is how our climate shock transmission channel look like. We work at 3 levels. At the level of scenarios, indeed, we consider scenarios aligned to a 2 degrees target, which is mostly the green one from the IPCC report 2014. Then we compute forward-looking trajectories of energy sector's market share, and in particular subsectors, both brown and green, using integrated assessment models. In this case, we have used the limits integrated assessment model, and in particular 2 models, GChem and WICH. For doing so, we use sector-level data and information provided by these models. Then we model the transmission of the shock from the sectors from the sector to the sector market shares along different policy scenarios, considering either mild policy scenarios or tighter policy scenario, which is the case in which we arrive in 2029, we didn't do anything and we had to introduce a carbon tax, and it will be much costlier. This is, for instance, what happens on the sector market share of coal-based electricity production. This is the business as usual scenario, and this is the change in sector market share, which is the fall under a mild and a tight policy scenario. Then we translate this into financial risk matrix by computing a value at risk for the aligned and misaligned companies, which will be the green and the brown one. In this case, we use firm and asset level data. Why? Because of this, because we will have several cases of companies, such as Eni, for instance, in Italy, which have both a part of energy generation from fossil fuels and a part of energy generation from renewables, but these are both in the same company. Put more simply, if a country delays its alignment to climate targets in terms of sector or technology mix profile, we might have a disorderly alignment where green and brown firms could face unanticipated, respectively negative and positive shocks in their market share, depending on their capex and on their strategy. Then, firms' profits and losses will reflect in the change in the expected value of their securities underlying, which could be equity, corporate bonds, and loans. Then we estimate the shocks that can be obtained from forward-looking trajectories based on the gross value added of the firm and the sector, computed with integrated assessment models. And then, of course, we transfer this in the financial contracts. This is an example, the example I did before. This is a negative shock on the sector market share, and because this is based on coal-based electricity. However, we could expect that for renewable energy sectors, the shock could be positive. Finally, we compute the value at risk at the firm level for both companies which are mostly producing electricity out of fossil fuels or renewable energy sources. What we see is that in a 2 degrees aligned transition scenario, the company A, which is mostly based on electricity generation, could have larger gains and smaller losses based on the computation of the value at risk than company B. This means that A will have a smaller value at risk. For this analysis, we consider an investor's information set which is incomplete. Indeed, the investor doesn't know the timing and distribution of climate policy shocks, and thus she cannot compute a traditional value at risk. She knows the magnitude of climate policy shocks computed with integrated assessment models, but she doesn't know her nor her competitors' portfolio exposure to climate risk. Finally, she knows the historical values of data on the financial performance of the firms and sectors in which she, in the brown or green energy sector. In addition, in this case, we consider a market which might not be efficient nor frictionless. This means that we cannot apply a traditional Merton model. This is due to the fact that there is growing evidence in the literature that climate risk is not reflected yet in markets' evaluation of financial contracts. We also recently contributed to an analysis of market indices. In addition, even if it was priced in, the complexity of financial contracts could lead to potential sources of mispricing when the system is much complex, even without considering climate. We proceed then to estimate the shocks on the value of the sovereign bond under climate policy scenarios. We want to model climate shocks transmission from fiscal revenues to the sovereign bonds value in a market that is not necessarily efficient. We assume that the sovereign bonds are not risk-free, but they are indeed defaultable by building on literature by Duffy and others. The payoff of the defaultable bond is dependent on the sovereign ability to repay the debt out of its fiscal revenues accrued until the maturity. And thus we get the sovereign default conditions as from 1, which means that the value of the net fiscal assets at the maturity should be smaller than its liabilities. We introduce some assumptions here. The first is that asset value is observable only at the investment time T0 and at the maturity, where the liabilities are known. The asset value at the maturity differs due to 2 types of shocks. One is an idiosyncratic shock, and the second is a climate policy shock. What happens with the climate policy shock is that it shifts the probability distribution of the idiosyncratic shock. The 2 shocks are considered independent so far. Finally, we consider that in a disorderly introduction of climate policy, the value of economic activities in either brown or green sector could be subject to unanticipated negative or positive shocks based on the characteristics of the company. Our investor is a risk-averse investor, which aims to assess the climate risk of her sovereign bonds portfolio under incomplete information and uncertainty. In this case, the future asset prices are subject to shocks depending on several elements, such as the sovereign future performance, the risk premia demanded by the market, the type and timing of climate policy introduction, and the outcomes of the country energy transition. The investor risk management strategy is based on a value at risk, and thus considers a set of feasible scenarios that the portfolio should withstand, and then compute at a value at risk which is conditional to those scenarios. And here we come to some results based on the application of our methodology to the sovereign bonds non-monetary policy portfolio of the Austrian National Bank, OMB, with whom we were glad to collaborate in the last year, and from which we got data on the exposure to sovereign bonds of OECD countries. Here we see the results on the shock, of the climate policy shock. We consider here a tight climate policy scenario on the securities revenue stream of sovereign bonds in OECD countries. We should consider that positive shocks on yield correspond to negative shocks on the sovereign bonds value. What we see here? Well, for disclosure region, I could not include the name of the countries, but here we have the name of the individual countries. Here we have the models regions according to the 2 integrated models that we use, GChem and WICH, to estimate the shocks on the sector market share. What we see is that actually largest negative shocks on the bond value and thus highest effect on the bond yields are related to 3 countries. One is Australia, the other is Norway, and the third one is Poland. What do they have in common? They have in common that their GDP and their economy is still either directly or indirectly, in the case of Norway, dependent on fossil fuel-based revenues. In contrast, positive shocks, this is the case of Austria, depend on the fact that the country has started to embrace low carbon transition, and thus high share of its fiscal revenues come from low carbon activities. The second result is the assessment of the impact of the climate policy shock, again considering a tight policy scenario, on the overall portfolio of the central bank. And here we see again, we compute it with the Which integrated assessment model. And again, the main shocks come from the countries we saw before. You might think that these shocks are small. Well, you might want to rethink about that for 3 reasons. The first is that tighter policy scenarios might be considered, since governments have not embraced consistently yet in the low carbon transition, and indeed we are already maybe not able to stay within the 1.5 degrees target. This means that probably tighter climate policies will be introduced, and according to the Stiglitz-Stern report on carbon pricing, the more we wait, the more the cost of the carbon per ton will be. Second, we use the integrated assessment models, policy scenarios, which are before the Paris Agreement, but we are working on integrating socioeconomic shared pathways, and so to update the policy scenarios. Third, I would like to draw your attention on the fact that even a few decimal points of expected change in GDP growth could change the impact yields due to the expectations of investors. This is actually what happened a few months ago in my country, in Italy. We had elections. In a few days, the spread increased a lot, despite the government did not even start to work. This is why even few decimal points could make a big difference, because if it occurs on a country which has a large stock of public debt, a jump in the spread could highly affect its interest rate and thus its cost of debt repayment. This means that our results should be considered as conservative. And here we come to the conclusions. What I show today is that we have developed a climate financial risk assessment approach to decision-making under uncertainty, which combines financial network models and financial asset pricing models, where we include climate. What we see is that climate risk could already change individual financial risk position, where high carbon intensity of firms and assets can negatively affect the climate alignment and the financial risk of an investor. In the contrast, the opposite holds true for low carbon firms and assets. In conclusion, our climate risk assessment framework allows to mainstream climate risk consideration in portfolios management strategy at the level of individual assets and identify the sources of potential misalignment. This is important, and I would say crucial in this specific political moment, to inform portfolios risk management strategies and the activity of financial supervisors and central banks to allow a smooth low carbon transition and preserve financial stability. So, thank you so much.
Thank you. Thank you very much, Irene. I would say, just as a personal note, I feel like a group of us global modelers have spent 5 years wandering in the wilderness, looking for people in the financial community to tell us what they want to do with our scenarios. And that is literally the first talk I've seen that had anything regarding that, let alone a whole talk with an integrated approach. So I personally very much appreciate that. So next for audience questions, any student questions? Students always sit in the back. Yes, sir. Can always rely on you.
Oh. How can we use this information to incentivize more investment in like clean energy and low carbon solutions? Because the capital intensivity is huge. It's like on the order of trillions of dollars a year. So can this be used to push investment in that direction?
Well, this approach, in the community, we say that the disclosure is important, and this matrix allows you to disclose the potential risks and opportunities of going green. So the risk of staying brown and the opportunities that you might experience in going green under different portfolios management strategies. However, disclosure is important, but unfortunately is not enough. There are several issues that should be considered, and I think that the two crucial ones are how to align the timing and the time expectations of investors, while climate change impacts are expected to be very long term, but investors' timing is very short term. And the second one is benchmarks, because investors actually still are rewarded for following a benchmark. What we showed in our recent analysis of the carbon exposure of the European Central Bank corporate bonds portfolio under the quantitative easing is that the benchmark is brown, and it's brown to stay, with maturities up to 2040. This means that we need to change the benchmark.
Yeah, that's big. Student questions? Any other student questions? Yes, sir. Yvonne.
Other than actually like pricing carbon, what are other things and other interventions that governments and central banks can undertake to actually incorporate climate risk into decision making? What are the different kinds of interventions?
Thank you. This is a very interesting question and a very timely question. So far, in the last year, economists have mostly been discussing about green fiscal policies, either subsidies to green investments or introduction of a carbon tax or carbon markets. However, more recently, there has been growing attention on what role could central banks' monetary policies play in the low carbon transition by signaling the market. A discussion on what role could central banks play is included in the report of the Network for Green the Financial System that I quoted before, and also in a series of articles which were published by me and my colleagues at the Vienna University of Economics and Business. And these include, first of all, promoting climate stress tests, both of investors, but also their portfolios. So if central banks want to signal the market, they should show leadership on this. And showing leadership means giving the good example. What we saw when we analyzed the carbon intensity of the European Central Bank quantitative easing purchase is that we are still far from that, even at the level of national central banks in Europe. And second, they should consider actually how to scale up and incentivize investments in the green sector, again, via signaling. There is a big discussion on what role could green bonds play. Green bonds could be an opportunity, but if well managed. First, we need a classification on what kind of activities could be defined green, but also brown. And probably, if we know that staying exposed on high carbon activities and assets is bad, probably we should penalize it with a brown penalizing factor. This is what the discussion which is going on, and which includes also central banks.
Great. Other questions? Let's go back there and then up here. Matt?
How could financial institutions be encouraged or maybe forced to use those financial metrics that you talked about to assess climate risk? how would you encourage them to like really use your research basically to actually take
Well,
this?
I'm not a financial supervisor, nor a financial regulator. What I can do as a researcher is to show what are the risks of staying brown and the opportunities of going green, and actually developing metrics that could be already applied. For a long time, the discussion was with also the One Planet Summit in Paris a couple of years ago. We don't have the metrics. We don't have metrics and methods. Well, here we have something that could be already applied, and we did it. So, starting to do so, investors could already figure out what kind of scenarios they should consider. They might have to consider. And there is also a lot of work going on in terms of voluntary disclosure. There was the task force on climate-related financial disclosure promoted by the G20, and also the Network for Greening the Financial System has recommended several initiatives, such as also what we saw before, according to Carney and de Gaulle, climate stress testing. These are only two options. Of course, there will be also others, but forcing investors, this is still a bit far to come.
Sir.
Thank you for your talk. So first, to make sure that I understood right, you were quantifying the losses that the portfolios would have at a national scale if they rely more heavily on, say, fossil fuels, and then they implement the climate policy, right?
Actually, no, what we saw is actually we consider a situation where there is a disorderly low carbon transition, which means that a climate policy is introduced in a late and sudden way. And we assess what happens in terms of financial value for investors who are exposed to both contracts issued by high carbon companies, and this, what we saw from with the value at risk, they would lose value. And in contrast, contracts issued by low carbon companies will gain actually value. In the case of the sovereign bonds that I showed, this reflects in the in negative an increase in bonds yield for countries whose GDP is driven by carbon-intensive companies.
So my question is, if a central banker knows that their yield is going to be lowered if they implement a sudden climate policy, wouldn't that incentivize for a status quo in terms of climate policy? Wouldn't that prevent or hinder the advocacy of the climate policy?
Well, first of all, the climate policy should be introduced by the governments. Actually, there was a lot of attention in the last few years, in particular after the last financial crisis, on what central banks could do. But so far, central banks' mandate is to maintain financial stability, and for some countries, like in the European Union, is to support the implementation of the agenda of the European Commission, which is in this case also the EU 2030 targets. But however, the introduction of climate policies stands on governments, not on central banks.
Right,
of course, the role of central banks is to monitor the sources of price volatility, which could lead to potential financial instability, and identify micro and macroprudential measures that could tackle them.
Can we go back there and then up here, and then one last one over there? So, sorry, I'm going to go up and then back.
Yeah, so you were focusing on the risk, I guess, of the disordered climate policy transition. Can you talk a little bit about, I mean, are there no risk at all if there is a more orderly policy transition? It seems like there's a lot of stranded assets and things like that that'll arise regardless of how orderly the transition is.
Good point, but we still don't have a counterfactual of an orderly low-carbon transition. So we mostly focus on a disorderly low-carbon transition because so far, except a few experiences of specific countries, we don't have a concerted action.
Okay, we're going to go here and then last word.
You began your talk by showing these three men who were the central bankers of I guess England, France, and China. Do you have is your assessment that these three men have taken your message to heart with research that you and Battiston and others have done. And does it make a difference? Are these guys, are they just totally politically pressured to make their decisions, or can they actually make their best decisions for a real investment?
Well, the three men that I showed actually did a lot to push on the on disclosure and implementation of climate risk metrics and assessment of portfolios exposure to climate risk. If it was due to our research, this I don't know. However, we have been in close dialogue with several central banks. I was at Bank of England 2 months ago presenting my research. My co-author Stefano Battiston has just published a contribution to Banque de France Financial Stability Board report. And we have been working with the Austrian National Bank and so on. Central banks have engaged with research in the last 2 years, so we hope that, and we saw several of our messages in their last reports, so hopefully so.
Yes, and that's what I can confirm. This group is a very anxious consumer of this kind of research, for sure. Last question over here.
Yeah, so in applying your approach to the Austrian Central Bank, you use WICH and GCAM as integrated assessment models. But there are a big diversity of assessment models. I think that depending on which one you choose, it could influence a lot of the results. So is your approach flexible and can it let people use all the kind of models if they want to? Or is it only compatible with WICH?
This is a very, very good question. Yes, it is flexible to integrate not only other types of integrated assessment models, which is what we did in the first climate stress test published on Nature Climate Change, where we consider all the 6 integrated assessment models under the LIMITS project, but also to integrate other type of models. In particular, we are working with the stock flow consistent agent-based models to derive the shock trajectories on the sector's market share.
Yeah, with that, I'd like to thank Irene one last time and the audience for great questions. Thank you very much.
Thank you so much.